$38 trillion. That is the current weight of the American national debt as of December 2025. It is a figure so vast that the human mind struggles to categorize it as anything other than an abstract statistic. But numbers at this scale are never abstract. They are structural gravity. If you believe this figure is merely a political talking point that won't touch your daily life, you are ignoring the most significant capital migration in 75 years. While the public remains distracted by the noise of the 24-hour news cycle, the world's most sophisticated financial architects have begun a silent, systematic retreat. They are rotating out of dollar-denominated assets with a precision that suggests they aren't guessing. They are reading a map. This isn't a theory born of panic. It is the observable flow of capital documented in public filings and treasury data. By the time you reach the end of this analysis, you will understand the specific mechanism of this exodus and why the smart money is moving now. We are witnessing the unfolding of a mathematical pattern that has dictated the rise and fall of every global superpower for the last 5 centuries. It is a cycle with identical stages, predictable warning signs, and a singular, devastating conclusion. The only variable is whether you recognize the signals before the exit doors lock. If you find value in these deep system investigations, I invite you to subscribe to the channel and join our community. Your support allows us to remain independent and focus strictly on the data that matters. Ensure you hit the like button to help this analysis reach those who are still operating under the illusion of permanent stability. I'm not here to tell you what might happen. I'm here to show you why the system is behaving exactly as history demands. Stay until the final chapter, because I will reveal the 3 specific indicators that prove we have already crossed the point of no return. The next 20 minutes will fundamentally reframe your understanding of the global financial architecture. To understand our current position, we must apply a structural framework to history. No empire collapses at random. They fall according to a 4-stage systemic cycle. Stage 1 is the ascension. A nation becomes the undisputed center of global finance. Its currency becomes the world's reserve, and capital floods in, creating an era of perceived limitlessness. Stage 2 is overextension. Success breeds fiscal arrogance. The government begins spending far beyond its tax revenue, funded by debt and currency debasement. Asset prices boom, creating a false sense of perpetual wealth. Stage 3 is the silent exodus. This is the critical phase where the insiders, the institutional smart money, begin a quiet rotation out of the system. They see the insolvency that the public ignores. This stage typically lasts 18 to 36 months and is characterized by a hollowing out of the financial core. Finally, stage 4 is the collapse, a rapid loss of reserve status, vertical inflation, and the destruction of the middle class. History confirms that once a nation enters the late phase of stage 3, the transition to stage 4 becomes a mathematical inevitability. The system enters a feedback loop where the cost of maintaining the debt accelerates the destruction of the currency. We are not merely observing a downturn. We are documenting the final transition of the dollar's hegemony. To understand the fate of the dollar, we must look back to the 1500s, when Spain was the undisputed titan of the world. At its peak, the Spanish Empire was a system of unprecedented wealth, fueled by a constant stream of gold and silver flowing from the Americas. The Spanish real was the global reserve currency, the absolute standard for international trade. If you were a merchant in Antwerp, a banker in Genoa, or a trader in Manila, you transacted in Spanish silver. This was stage 1, absolute dominance. King Philip II controlled a domain that spanned from the Philippines to the Netherlands, and his military was regarded as the most advanced and unstoppable force on the planet. But wealth of this magnitude creates a specific kind of systemic blindness. Because the treasure fleets from the New World seemed eternal, the Spanish crown began to treat debt as a secondary concern. This marked the transition into Stage 2, overextension. Spain engaged in a series of perpetual conflicts, wars with France, the Ottoman Empire, the Dutch, and famously, the English. Maintaining the Armada and the tercios across 3 continents required capital that even the mountains of Potosi couldn't provide. By 1550, the structural reality was grim. Spanish government spending was running at roughly 300% of its tax revenue. To bridge the gap, Philip II did exactly what modern governments do: illegally debased the currency and borrowed heavily from international banking families like the Fugers of Germany and the Grimaldis of Genoa. The empire felt rich because asset prices in Madrid were skyrocketing, but the foundation was hollowing out. The debt became a monster that needed constant feeding. Eventually, the interest alone began to consume the entirety of the silver arrivals. By 1555, the smart money of the era, the Genoese bankers who had financed the crown for decades, recognized the mathematical impossibility of the situation. They entered Stage 3, the silent exodus. They stopped accepting Spanish promises and began demanding physical gold or assets in more stable jurisdictions like the rising Dutch Republic. In 1557, the inevitable happened. Spain declared the first of many sovereign defaults. Because they could no longer pay the interest, the credit markets froze. The crown tried to solve the crisis by seizing private silver shipments, which only accelerated the flight of capital. Between 1557 and 1597, Spain defaulted 4 times. Each time, the government promised it was a temporary liquidity issue, but the mathematics said otherwise. The middle class was decimated by inflation as the government flooded the streets with low-quality copper coinage to replace the silver they had spent on wars. By 1600, the Spanish Golden Age wasn't ended by a foreign invasion. It was liquidated by its own balance sheet. The global reserve status migrated north, leaving Spain a debt-ridden shell of its former self. It is a hauntingly precise mirror of the fiscal trajectory we see today. As capital fled the dying Spanish system, it found a new home in Amsterdam. By the 1600s, the Dutch Republic had engineered the most sophisticated financial system in human history. They didn't just have a currency, they had an entire infrastructure of capitalism. The Dutch East India Company, VOC, was a corporate behemoth, valued an inflation-adjusted $8 trillion, effectively eclipsing the combined weight of today's tech giants. The Dutch guilder became the new global reserve currency, and the Bank of Amsterdam became the world's first true central bank. For nearly a century, the world operated on Dutch credit. This was Stage 1 in its purest form. Innovation-led dominance. However, the Dutch fell into the same trap as the Spanish before them. Success led to the arrogance of Stage 2. To protect their vast global trade routes, the Dutch had to fund a massive navy and engage in constant, expensive wars with England and France. Between 1650 and 1690, the Dutch national debt exploded 20-fold, rising from 4 million guilders to over 80 million. To sustain this, the Bank of Amsterdam began a secret practice that would eventually lead to its ruin. They started lending out depositor money to the government to fund military deficits. They were running a fractional reserve system while publicly claiming every guilder was backed 100% by physical metal. While the public was distracted by the tulip mania, an asset bubble where single flower bulbs cost more than luxury homes, the structural rot was deepening. The smart money saw the divergence between the bank's rhetoric and its actual balance sheet. By 1690, the silent exodus began. Wealthy Sephardic merchants and international financiers started moving their operations to London. They didn't make a scene. They simply opened offices in England and redirected their trade fleets. They knew the Bank of Amsterdam was functionally insolvent. By the time the French Revolutionary armies invaded in 1795, the Dutch system was already dead. The invasion just provided the final shock. When the bank's books were finally opened, the fraud was revealed. The guilder collapsed, and the Dutch Golden Age evaporated almost overnight. The pattern remained undefeated. Overextension leads to secret insolvency, which triggers a silent migration of capital, ending in a total systemic reset. The money moved to London, setting the stage for the British Empire, but the mechanism of decay remained identical. The British Empire provides the most recent and relevant blueprint for the current American predicament. For over 2 centuries, the pound sterling was the unchallenged master of global trade. At its peak, the sun truly never set on the British flag, as London controlled nearly a quarter of the Earth's landmass and population. The City of London was the heartbeat of global capital. If you needed to finance a railroad in the United States or a mine in South Africa, you came to London for sterling. This was the ultimate stage one. The gold standard was essentially a British invention designed to stabilize a world that revolved around the pound. However, the 20th century brought the devastating costs of stage two, overextension. 2 world wars transformed Britain from the world's largest creditor into its largest debtor. World War I alone cost Britain over £44 billion in inflation-adjusted terms, forcing the government to borrow heavily from its own citizens and the United States. By the end of the conflict, Britain's debt-to-GDP ratio had climbed from a stable 30% to a staggering 130%. This is a critical mathematical threshold, as it is the exact level the United States sits at today. Britain attempted to return to the gold standard in the 1920s to project strength, but the underlying economy was too hollowed out by debt. The system broke in 1931, and by the end of World War II, Britain was financially paralyzed, surviving only through massive emergency loans from the U.S. In 1949, the silent exodus, Stage 3, began in earnest. Major British industrial titans like Unilever, Shell, and British Petroleum didn't collapse. They simply began redirecting their capital growth toward the United States. They shifted their primary investments, talent, and headquarters focus to where the growth was. Wealthy British families, recognizing that the pound was destined for devaluation, moved their assets into Swiss francs and American dollars. Between 1945 and 1960, foreign investment in the UK dropped by over 60%. The smart money had already left the room long before the public realized the party was over. The final collapse, Stage 4, arrived in 1967. The government was forced to devalue the pound by 14.3% overnight. Then, in 1976, the ultimate humiliation occurred. The former global superpower had to beg the International Monetary Fund, IMF, for a bailout to prevent a total currency meltdown. The pound lost its reserve status, and the center of the world moved to New York. The pattern was complete once again. History shows that when debt reaches 130% of GDP, the transition from Stage 3 to Stage 4 is not a matter of if, but when. The American era began officially in 1944 at Bretton Woods, where the dollar was crowned the world's reserve currency, backed by gold at $35 an ounce. For decades, the United States enjoyed the exorbitant privilege of Stage 1. As the only major industrial power left standing after World War II, America saw an unprecedented flood of global capital. The dollar became the oxygen of the global economy. This era of absolute dominance lasted until 1971, when the structural foundation was fundamentally altered. On August 15, 1971, the U.S. moved into Stage 2, overextension. By ending the dollar's convertibility into gold, the government removed the last physical constraint on spending. The results were immediate and exponential. In 1980, the national debt was a manageable $900 billion. By 2008, it hit $10 trillion. By December 2025, it reached the astronomical figure of $38.4 trillion, a 4,200% increase in just 45 years. But the government debt is only the tip of the iceberg. When you include corporate, household, and institutional debt, the total U.S. debt load exceeds $100 trillion, or 370% of GDP. To put this in perspective, Spain defaulted at 200% debt to GDP. The Dutch Republic collapsed at 250%. Britain lost its reserve status at 130%. At 370%, the United States is an uncharted mathematical territory. The only way the system continues to function is through circular financing. The government now pays over $1 trillion a year just in interest payments, more than its entire defense budget. To fund this, the Federal Reserve must print money to buy the government's own debt because there are no longer enough external buyers to fill the gap. This is the classic hallmark of Stage 2 late phase asset bubbles. While real wages for the average worker have stagnated, the stock market and real estate prices have hit all-time highs, driven not by productivity, but by a tidal wave of devalued currency. The Federal Reserve's balance sheet grew from $800 billion in 2008 to nearly $9 trillion in 2022. They have propped up the entire system by absorbing the risk themselves. But as history teaches us, you can print currency, but you cannot print wealth. The stage is now set for the transition we are seeing today, the movement of the smartest players toward the exit. We have reached Stage 3, the silent exodus. Historically, this is the most dangerous phase because the transition is invisible to those who only consume mainstream headlines. In this stage, the smart money, sovereign nations, and institutional architects begins to dismantle its exposure to the reserve currency. The data confirms this is no longer a hypothetical risk. It is an active liquidation. In 2013, China held over $1.3 trillion in U.S. treasuries. By late 2025, that figure has plummeted toward $760 billion. China has systematically offloaded more than $500 billion in American debt over the last decade, replacing it not with other currencies, but with physical gold and strategic infrastructure. China is not alone in this retreat. Japan, traditionally the largest foreign holder of U.S. debt, has reduced its position by more than $220 billion since 2022. Saudi Arabia, the cornerstone of the petrodollar system, has been quietly diversifying its reserves, as have Belgium, Switzerland, and France. Even the Federal Reserve itself has entered a phase of quantitative tightening, allowing bonds to mature without reinvesting, effectively draining liquidity from the system. When the world's largest holders of a debt instrument begin to sell simultaneously, the law of supply and demand dictates that the value must eventually collapse. The only reason the system hasn't reached a breaking point yet is because the U.S. government is increasingly buying its own debt through circular financing, a move that mirrors the final years of the Bank of Amsterdam. The infrastructure for a post-dollar world is being built in the shadows. The BRICS nations, now representing over 40% of global GDP, are developing alternative payment systems designed to bypass the SWIFT network entirely. We are seeing bilateral trade agreements between China and Brazil and India and Russia that settle in local currencies. The petrodollar arrangement, which once required all oil to be priced in dollars, is fracturing. While the 1974 agreement with Saudi Arabia was more of an informal understanding than a rigid contract, the practical reality is that Saudi Arabia is now openly exploring yuan-denominated oil sales. This isn't just a political shift. It is a structural hollowing out of the dollar's primary source of demand. Once the dollar is no longer required to buy energy, its status as a reserve currency becomes a legacy of the past rather than a necessity of the future. While sovereign nations sell off treasuries, the world's largest private asset managers are executing their own Stage 3 playbook. BlackRock, which manages over $10 trillion in assets, has fundamentally restructured its institutional portfolios over the last 24 months. They have moved aggressively away from concentrated U.S. Treasury exposure, pivoting toward international infrastructure, European commodities, and hard assets in emerging markets. This is not a vote of no confidence expressed in a press release. It is a cold, mathematical reallocation of risk. When the largest capital allocator on Earth begins to diversify away from the risk-free asset of the U.S. dollar, it signals that the asset is no longer considered risk-free. This institutional migration is visible across the entire spectrum of high finance. JP Morgan has restructured its institutional allocations to favor international equities over domestic growth. Goldman Sachs has issued repeated warnings regarding the long-term sustainability of the dollar's purchasing power, advising clients to increase exposure to gold and real assets. Bridgewater Associates, the world's largest hedge fund, has positioned its flagship funds for a secular devaluation of the dollar for years, citing the exact historical parallels we have discussed today. The smart money is not waiting for a crash. They're creating the conditions for it by removing the floor of support that has held the dollar up since 1944. The implications of this private exit are systemic. When institutional liquidity leaves the U.S. market, volatility spikes. We are currently seeing the largest gap in history between the paper economy, the stock market and financial derivatives, and the real economy of production and wages. This divergence is only possible because of the massive monetary expansion of 2020 to 2022, where the M2 money supply increased by 40% in just 26 months. But that liquidity is now being withdrawn. The smart money knows that when the Fed is forced to choose between saving the currency from hyperinflation or saving the stock market from a crash, they will ultimately be forced to let the market fall to prevent a total social collapse. They are positioning themselves to be the ones buying the wreckage at the bottom, rather than the ones holding the bag on the way down. We have examined the historical precedents and the real-time data of Stage 3. Now, we must look at the mechanics of the endgame. When a reserve currency reaches this level of debt saturation, the central bank enters a liquidity trap. The Federal Reserve currently faces an impossible mathematical choice. If they raise interest rates to combat the inflation caused by a $38 trillion debt and massive money printing, they make the interest on that debt unpayable. At 5% interest, the U.S. would own nearly $2 trillion annually just to service the debt, more than double what it collects in corporate tax revenue. This would trigger an immediate sovereign default and a total economic freeze. However, if they keep interest rates low and continue printing money to buy their own debt, they accelerate the destruction of the currency's purchasing power. This leads to hyperinflation, where the nominal value of assets may rise, but their real value, what they can actually buy, collapses. History shows that every empire in Stage 3 eventually chooses the latter. They print until the confidence breaks. When that confidence snaps, the dollars held in foreign central banks, trillions of them, will flood back into the American domestic economy as nations trade them for anything of tangible value: land, energy, and gold. This homecoming of offshore dollars is the catalyst for Stage 4. In Stage 4, the transition is gradual, then sudden. You wake up one morning and find that the dollar has been devalued by 20% or 30% against a basket of commodities or a new BRICS-aligned reserve asset. This isn't speculation. It is the exact path taken by the Spanish real, the Dutch guilder, and the British pound. The middle class, which holds its wealth in dollar-denominated savings, pensions, and traditional insurance products, is the primary victim. Their nominal balance stays the same, but the cost of bread, fuel, and electricity doubles or triples. The wealth isn't destroyed, it is transferred. It moves from the savers to the debtors, and from the public to the institutions that saw the pattern early and moved into hard infrastructure. This is the structural reality of a systemic reset. The mathematics of $38 trillion do not allow for a soft landing. The system is not breaking. It is completing its cycle. The patterns we have discussed over the last 20 minutes are not theories. They are the documented heartbeat of economic history. From the gold-laden galleons of Spain to the digital ledgers of modern Wall Street, the cycle of Stage 3 remains undefeated. The silent exodus is happening right now. The smart money has already identified the exit. The question that remains is not whether the system will reset, but how you will be positioned when the final stage accelerates. Exceptionalism is a story empires tell themselves to avoid looking at their own balance sheets, but mathematics has no loyalty to narratives. If you have found this structural analysis vital, ensure you have subscribed to the channel. In our next investigation, we will dive deep into the specific asset classes that survived the collapse of the British pound and the Dutch guilder, the survival assets that preserve generational wealth during the transition to a new reserve currency. Hit the bell icon so you don't miss that data-driven breakdown. Please like this video to support our work in exposing these systemic mechanisms. It helps us bypass the algorithms that often prefer surface-level noise over structural truth. The information is now in your hands. You can choose to ignore the $38 trillion debt, the central bank sell-offs, and the institutional pivot, or you can begin your own silent exodus into assets that the government cannot print into worthlessness. History doesn't repeat itself, but it certainly rhymes, and right now, the rhythm is screaming that we are in the final months of Stage 3. Don't wait for the mainstream confirmation of a crisis that the data has already predicted. Position yourself, diversify your risk, and stay focused on the numbers beneath the headlines. Thank you for watching, and I will see you in the next video.